Hey everyone, welcome in to another daily editorial here on the KE Report. We are chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, I know Fed Day. I know you don't like Fed Day. A lot of people are watching today, though, for the Fed to see if they pause or if they go ahead with a rate hike. Either way, we can see just by market reaction that the market is really, I think, started to price in a pause and maybe a prolonged pause. Who knows? But either way, markets have been doing pretty good. The broad averages have continued to move higher. They moved higher for the last, let's say, 5-6 weeks, and we've actually seen a little bit better breadth. Let's start with the markets because you have written to your subscribers saying that there could be some strength in the markets, and that just can further distract people from, let's say, the precious metals sector into the market. So, Jordan, what are you thinking? Is this rally for real? Have we seen some significant breakouts, considering many of these markets have broken out to one-year highs?
Well, I think in a short-term sense, it is real. I mean, you did have the S&P several weeks ago breaking out from a little bit of an ascending triangle pattern, and so that has a measured upside target of around 45.20. And if you look at the weekly chart and you look at 45.20, that is an area of some horizontal resistance. So that's been my target for several weeks. And, it's trading at 43.74 now. Tech stocks are getting really, really stretched. And if you look at sentiment in the stock market and positioning, it's starting to get more bullish. And if you think back like a month or 2 months ago, positioning, and that was another reason that the market, something I mentioned, that the market would be able to move higher. It's just that people were underinvested in the stock market. And so I think that is driving the market higher. And I think it still has a little bit of room to run. But, if you look at the tech stocks and the QQQs, those are getting really stretched. I mean, that's made like a vertical move. And so that'll be something to watch if we see a correction or a snapback in the NASDAQ first. Because, I just pulled up that chart. I mean, that's had a huge move this year from 260 at the beginning of the year to 364. That's a huge move. And, it's coming up towards all-time high resistance around 400. So, I mean, that's definitely something to keep an eye on because tech stocks led this move. And if they have a big correction or roll over, that could hurt the overall market. So I think the market still has some legs, but we definitely have to be, wary about a coming recession and the market running into resistance and getting really overheated. I mean, as a gold bug and precious metals investor, I would like to see the stock market like really get extended over the next month or two and the economic data get worse at the same time. Like that would be a really good combination because then the market would be setting up for a violent bearish reversal, sometime in the summer, maybe later in the summer when the data just starts to get worse and worse.
Yeah, Jordan, it seems like some of the people that have been on the sidelines in the general markets have started piling back in the last few months. It's been on a good trajectory for about 8 months now, 9 months, but it seems like lately there's been some momentum to the upside in the general equities. And to that point, when you look at the precious metals and contrast it, I know you like to look at intermarket analysis. What's your take on how gold versus the S&P, gold versus the NASDAQ would probably even be more extreme, but just gold versus the S&P, how is that looking to you? Do you think there could be a reversal of fortunes in the second half of this year where the markets do get to that tipping point and correct, and where the precious metals maybe diverge and start moving up in tandem with the markets pulling down?
Well, that is what I'm looking for. And looking at the gold to the S&P chart, that ratio, I mean, it has come back quite a bit. I'm looking at it now. It's come down to the 400-day moving average. I mean, there can be a lot of volatility in the ratio, but I would like to see it make a big rebound sooner rather than later. But I will say I really like how this is setting up in that you have the stock market broke out from that ascending triangle pattern. And, tech stocks they were doing really well before that breakout and after that breakout. But what I mean in terms of, why I like how this is setting up is I like the fact that the market's going up, it's starting to go up at a more accelerated pace. and that precious metals are doing nothing. They're correcting, they're basically yawning. The charts in a short-term sense look more bearish than bullish for me. I really like that setup because if we get problems in the economy in the second half of the year, third or fourth quarter, stock market gets hit at some point, that's going to be the recipe for precious metals to diverge and move much higher. So I'm not worried that they're going to get taken down because of exactly what we've been seeing in the last month or two and what we could continue to see over the next few months, which is stock market moves higher, more money comes in, and precious metals, maybe they correct a little bit more and trade a little bit lower in terms of price. That would be a good setup because it sets up nicely for, again, the presumption that later in the year or later in the summer, you're going to get data that's worse and worse. Then you get a recession. That's bad for the stock market and corporations. The stock market sells off. Fed has to cut rates. That's the perfect setup for precious metals then, and gold especially, to make that move to and through $2,100 an ounce.
Jordan, do you ever look at outside of the gold to, let's say, S&P chart, the GDX to S&P chart or GDXJ to S&P chart and look at those comparisons?
Yeah, I mean, sometimes I do, but with where we are here and now, I just think, as someone once told me, like, gold is the granddaddy of commodities and precious metals. And so if you look at the miners, they're such a function of the gold price, obviously, and their margins and costs. And so I think in a short-term sense, for short-term moves, I think GDX to the S&P and GDXJ to the S&P, those are important ratios, and I do look at them. But like on a big picture, macro basis, I focus mostly on gold against the S&P, just because that's where the big money is going to go into first and foremost. But I mean, I do look at the miners to the S&P. I do look at those ratios from time to time. It's just that I think you're going to get much stronger and more reliable signals from focusing on gold. And I will say that, presuming gold has this breakout through 2,100, then when we get into a real bull market, then at that point I think looking at the miners against the S&P, it'll probably have more value at that point than it does now. Just because at that point there's going to be a lot more money coming into the sector and more of it will be going into the stocks.
Well, Jordan, I'm assuming that you would feel the same way about silver then that you do about the stocks, that, if gold is the granddaddy commodity and it's the one that's driving the bus, when it finally breaks out above 2,100, I would imagine that even though silver has that industrial component, as we discussed last week, it's really the investment demand that drives the price in silver. And I would imagine that silver would get the memo and start catching up like the mining stocks would. Is that how you're looking at silver, or is there anything else you see on the silver charts you want to note?
Yeah, I mean, that's really how I see it, in that, like we talked about last week, gold typically breaks out first, and then it's followed by silver making its own breakout. And so, therefore, right now, I mean, I know if we look in the last week or so, silver has been a little bit stronger than gold, which, I mean, you could say that's a good sign. But I mean, I'm searching in my head for some riveting insight about silver. But honestly, I just got nothing right now. I just it's a beta play on gold, and I even if silver outperforms gold for a little while here, I mean, maybe that's a harbinger of a breakout coming in gold. But I really don't know. But it's I look at silver. Its performance, it's very similar to how the juniors and GDXJ performs. It's I don't want to just say it's 100% dependent on gold and the gold price and breaking that resistance, but I mean, when it comes down to it, that's the case.
So is this simply just a waiting game then, Jordan? A time to, I guess, relook at your portfolio, see if you're comfortable with the stocks or the allocation you have to the gold sector, and simply sit on your hands, maybe make a couple trades, but don't do anything too aggressively?
Well, I mean, it's hard to make a generic comment on that because everyone's different. Everyone has a different strategy. But I would say, focus more on the companies and quality companies. And, you could look at your portfolio and reassess everything and, make sure that, you have what you think are the best companies that are going to really be able to add significant value in the next few years, especially as we probably go into a precious metals bull market. If you see something that gets really oversold, is trading down by support, you could add to those positions. I wouldn't be, chasing strength right now in precious metals. I mean, at some point you will want to do that, but I generally agree with your comment. It is a time to focus more on your companies and do more company analysis and company research. And with that being said, Corey, I mean, timing is very difficult. So when gold starts this breakout move, I mean, it could only be 1 or 2 months away, or it could be 6 or 7 or 8 months away. I tend to think it's probably going to be somewhere in the middle of that time frame. But I mean, it can be really difficult because there could be a point this summer where, and maybe it's now, where we're just thinking, gosh, this is like this move is going to be 6, 7, or 8 months away. Like nothing is happening, but you might get some more banks failing or something else happens, and then suddenly the Fed's done and the market is thinking they're going to cut, and then you have gold back at like 2050, like a hair from breaking out again. That's one scenario to think about. So I do think you want to be positioned for that move. And you don't want to just assume, well, this is not going to break out for 6 or 9 months or years, nothing to do. Then, you could get really caught off guard when it happens.
All right, Jordan. Well, look, I wish we could be a little bit more excited about everything, but quite frankly, there are a lot of markets out there that are kind of range bound still, and everyone is waiting, unfortunately, for what the central banks are going to do, and unfortunately for what that follow through is going to be of all these higher rates. Still a lot of people looking at the second half of this year as recession, a lot of fears floating around, but boy, oh boy, these markets, with at least the recent breakout we've had here to 1-year highs, markets are still showing some strength. So, hey, that's what we, I guess, can focus on. There are some people making money in these markets. You just need to be very, very selective. Jordan, thanks for your time. We'll chat next week. Have a great rest of your week.